Hello, gentlemen, and welcome to another Pallavi Market Research video. The best videos of all videos in any category ever. On what channel can you watch such few videos and learn so much? I have no idea. This is the channel I would want if I were you, and it is becoming manifest every day a little bit more, a little bit, tiny bit for more. And there's no rush to this. We'll continue doing this until you all have hundreds of millions of dollars. I don't care if it's just the hundreds of you who follow me currently and watch these videos. I really don't give a fuck because we don't need a lot of people to have this beautiful community flourish. And today is a very special day for this community, and hopefully you will find out later today. Now, we're going to be covering different investment funds and types. This is a little bit boring. Really, I'm pitching this video well today. But we're just going to kind of break down the fund industry and the different funds that exist. So you can see that as of the end of 2023, there's about $100 trillion worth of assets under management capital that's inside of this investment fund industry. And I pulled like 30 of the most common investment fund types into this list. And we're going to kind of just talk about each of them and what makes them unique, the fee structures, how you make money in it, and how you can even participate or start one yourself, all that kind of shit. Okay. So mutual funds make up about 60% of this 100 trillion. So that's like vast majority of investment funds are actually in mutual funds, which I actually was a little bit surprised about. A little over 10% is in ETFs, a little bit over 10% is also in private equity. And then hedge funds represent about 4%. And then everything else is kind of evenly distributed across the rest of these things, with venture capitals becoming a lot larger very quickly relative to, say, like an income fund, which isn't growing as quickly. Now, in order to understand how these fees work, you have to basically understand that mutual funds, index funds, and ETFs only capture a management fee. And those fees typically range from 0.02%, so that's like the largest index funds, to 1.5%, which is like the most speculative niche kind of mutual funds. Okay. While hedge funds, private equity, VC, and REITs all take a management fee and a carry. And a carry is a percentage of profits. So if I make, if I take $100 and I turn that into $200, right? That's a $100 profit. I get $20. That's what a 20% carry is. It's a percentage of the profits that you make. And that's how hedge funds make money. That's how they should be making money. But obviously, there's a whole management fee game there too. So say you are managing a hedge fund, you have $100 million, you get to take 2% of that $100 million every year to pay for your costs, your salary, your staff's time, the office that you're in, all that stuff. And then you get to also capture 20% of the profits that you make. And if you want to kind of understand this a little bit more, you can go watch the Origins of Finance video, which is one of our earlier videos. So we're just going to kind of randomly pick a few of these to talk through. The index funds, obviously that includes things like the S&P 500, aim to replicate the performance of a specific index or a specific basket of assets, or specifically securities in this instance with the S&P 500. Typically, they have a very low turnover. They're not buying and selling assets that frequent, and they don't have high management fees at all. That's why it's the premier thing that people point you to when they're like, hey, this is where you put your money. And if you watched yesterday's video, you understand that 26,000 stocks, okay, have been IPO'd since 1926. And only 86 of those stocks are responsible for half of the appreciation in the US stock market. So using an index fund like exposure to capture the appreciation of those massively disproportionately growing, whatever the heck you want to call them, stocks, companies, you need to have index exposure. But like I talked about in previous videos as well, index funds like the S&P 500 may not integrate you with your value system. Maybe you don't want to own McDonald's stock Pfizer stock, Boeing. Maybe you don't want to support the fast food industry and the industrial military complex and big pharma, because that's what you're doing when you're buying the S&P 500. You're literally becoming a stakeholder inside of those. You are like I'm gonna keep talking about this forever. If you own a share in a stock like that, that is like 10 to 100 times more supportive for that business than you voting for a president, than you voting for any democratic process in our current socioeconomic system. But I'm not going to continue to bore you guys about that. So distressed security funds they basically invest in securities of companies or real estate projects, things like that are distressed. So you can visualize this as like a cheetah waiting in the grasses. That's what these fund guys do. They just kind of hill in the grasses, waiting for some limpy elk, or not an elk. I don't know what kind of fucking deer shit. Some deer fucking thing. Some limpy, frail deer to walk by so you can get that easy kill, right? This is a really effective way to be a fund manager, because when you're a fund manager in a distressed securities fund, you're forced to literally, you can't even participate in things that aren't distressed. Like when you raise the capital and you have these limited partners, right? You literally have to tell them like, hey, this is our definition for what a distressed asset is. If it doesn't fit these characteristics, we can't buy into it. So when the economy's doing well, it's kind of hard for them to do things. So they're just like waiting in the grasses, literally. So they're like forced to sit on the sidelines a lot until a crash happens, and then they go in and they make their moves, which I think is a much, much better strategy than a lot of these hedge funds that you see that are just like, oh, they're just throwing money at the wall, you know? A lot of people are doing that, right? If you can be the guy who's just, or the cheetah that's just waiting in the grasses and is only making like one investment every 1 to 2 years, and you're just like going for the kill every single time when you see that, you see that limp in that business, or you see that blood spill in that real estate project, right? That's where like crazy money is made, and these distressed security funds just crush it. But they're higher risk, higher return, high fees, and a carry. So these international funds, I think, are going to become a lot more popular over the coming years. That's why I'm highlighting the international global funds here. These are funds that invest in assets located outside of investor countries of residence. So if I'm in Puerto Rico, I'm not investing in any company in Puerto Rico. I'm investing in everything outside of Puerto Rico. That's an international fund. And a global fund is basically me investing in Puerto Rico and everything outside of it, right? It's a small difference, but it matters a lot. And I would encourage you, if you're looking to invest in a fund or whatever, explore these international funds that are managed in the US or even outside the US, global funds, because Peter Schiff has a really interesting, I think, like, he has this fund that's a foreign and international fund like this, and it's an, I think, income dividend paying thing. It's like where he basically buys into this different portfolio of dividend paying stocks that are not denominated in US dollars. So like, maybe a company out in Sweden, right? That has, their local currency, where they're not, so they're paying dividends, right? But they don't have the same inflationary risk as American companies do. And I think that's a really sound strategy for the time that we're in this moment. Now, merger arbitrage funds, these are the sneakiest, foxiest, the funds that are most at risk of like insider trading and things like that. Because whenever there's a merger or an acquisition that's announced, there's massive price swings in either directions, right? And so if you can catch those early and ride those swings, that's what these funds are dedicated to doing. They're basically like, okay, well, there's this merger happening. We're hearing rumors about it. Boom, we're going to get in and, make the speculation that, there's going to be a 20% dip if this merger occurs, or a 20% increase, whatever it might be, right? They're trying to take advantage of these arbitrage moments, these moments of overreaction, right, in the markets due to some kind of news that's big and uncertain, right, like a merger or an acquisition. Now, fund of funds in my opinion, the most interesting, and it's the easiest to start in a way also. So let me explain. A fund of funds is a fund that invests in other funds, kind of self-explanatory. Um, one of my mentors, he runs one of the most successful fund of funds in the whole world. And he started it by becoming a capital raising, like he raised capital, right? He got paid to raise capital for the largest hedge funds in the world. And he started off obviously like raising capital for the, the smaller funds, right? But what he would do is he would get a fee. So like say he raised $100 million and he got a 1% fee for the amount of money he raised. So he got $1 million. And what he would do is he would take the fee that he would get and invest it in the fund that he raised capital for, right? And so he kept doing this. And what he did by accident, he created a portfolio of fund of funds. And so now he raises capital to invest in the funds that he raises capital for. And I asked him the other day, I was like, hey, who's your biggest client right now? And his biggest client is the Vatican. Now, Brookfield Infrastructure Partners, infrastructure funds. We covered Brookfield Infrastructure Partners on one of our previous videos, like I think it was the first stock report we broke down. And this is an infrastructure fund, okay? These are funds that own assets that have a buyer of last resort, like a government, right? They buy things like transmission lines, they buy things like ports and solar fields, like electricity generation, right? They literally have like guaranteed buyers because, I mean, if everything goes to hell, they're going to be the last ones to survive because you have to pay them for your lights, gas, everything. So infrastructure funds are very interesting to study because they're currently highly monopolized. Not a lot of people understand that there's so few infrastructure funds. And and if you understand funds, it's like you want to have a huge um, assets under management. And it's hard to start an infrastructure fund because in order to participate in infrastructure, you need to have a huge amount of capital, right? But the fees are crazy. Like imagine getting 2% every year on a $1 billion, $10 billion fund, right? Now, obviously the profits that you get from a deal like this isn't as sexy, but because you are forced into getting bigger and bigger and bigger, then your just consistent cash flows are mind blowing. And it's an awesome, awesome investment. I think it's a very underrated space in the entire market sector. Okay. And then income funds. Lastly, these are just steady income streams to investors through dividend and interest payments. So, like, say I'm a fund manager of an income fund. Maybe I'll buy a portfolio of dividend paying stocks. Maybe I'll put out some loans. Maybe I'll buy some bonds, right? Some corporate bonds, some government treasury yield bond, blah, 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 right? These things are very, very, this used to be a lot more popular in like the 50s, 60s, 70s. And they're less so popular today because we've had so much success with like venture funds and just the S&P 500 performing so well. So, but I think that there's a really interesting opportunity right now to utilize I'll just share this idea with you guys. I think there's a great possibility for a income fund manager to partner with a venture capital manager and to create a more of a hybrid fund where you are basically buying into, say, a bunch of dividend paying stocks that you really believe in long term, say like over a 10 to 20, maybe even 50-year period. And then over the course of the first 5, maybe 10 years, you invest all of the dividends into venture capital plays, right? You just take all of the dividends that you're receiving from that portfolio, why can't I talk? Portfolio that you built through the, income fund. And then you take all of that and you don't provide the income to the LPs, you invest it into venture. And then with the winnings from the venture capital portfolio, you just go and buy back the same stocks that are in your income portfolio. And then after 5 to 10 years, you have an income fund that's maybe 2 times, maybe 10 times bigger than it was originally. That I think is I don't know why. I mean, people must be doing this, but I haven't met anyone who is. All right, guys, that's today's video. I hope you enjoyed it. We will continue doing these. I'm so happy to be back doing these. I should have never even taken a break. What's wrong with me? I'm so sorry.